Hi guys, welcome to Stock Brains. My name is Ayush and today in this video we will discuss about trends, the basic. So trend is the most important concept of technical analysis, and when it comes to CMT exam then it is one of the most important concepts. So we must know what is trend, and in this video we will only and only talk about the basics. We will not go to the advanced level, and I'll try to teach you everything in very simple way. So in this chapter you will be able to understand what is trend. In this video you will come to know what is trend and why determining trend is important, why we should identify the trend. That's what we will learn, and after that we will discuss the difference between primary, secondary, minor and intraday trend. Then we will discuss assumptions of technical analysis. Assumptions of technical analysis is one of the most important concept in CMT exam, so I would recommend you to read this in your CMT book, and after reading the book you can watch this video, and you can do vice versa as well. Now, technical analysis is based on one major principle. When I talk about technical analysis, it has some major principles, some major pillars, and trend is one of the major principles of technical analysis. Why is it so? Because whatever indicators we use, like Bollinger Bands, we use MACD, RSI, we use a lot of things. We draw support and resistance line, we draw trend lines, we do all of that stuff to figure out what is the trend, so trend is important. Now the question is, what is this trend? So trend basically is a general direction of the market. So whenever somebody asks you the definition of trend in the stock market, you can say that trend means general direction of the market. So trend can exist in three direction, and here I am doing a direction based classification of trend. So trend can exist in three directions: uptrend, downtrend and sideways. So most of us know what is uptrend, downtrend and sideways, but those who do not know this, I'll try to explain this thing in very easy way. So if I talk about uptrend, uptrend looks like this. Uptrend means any financial instrument is going up. So stocks or any financial instrument do not go up like a rocket. They go up like this. They go up a little bit, then they go down a little bit, then they go up a little bit, then they go down a little bit. So they form higher highs and higher lows. So it is the classical definition of uptrend, which is uptrend consists of higher highs and higher lows. So this is what you need to know about uptrend. So we will discuss this uptrend later on in our videos very elaboratively or at a very advanced level. Now let's talk about uptrend example. So uptrend example looks like this in real charts. So as you can see that the stock is making higher lows. As you can see that it is making higher lows and higher highs. So this is what uptrend is. Now, when I talk about downtrend, downtrend is just opposite of uptrend, which will have lower highs and lower lows. So, a stock again does not go down like a rocket. It goes down like this. It makes a new low, then it goes up a little bit, then it makes a new low, then it goes up a little bit and makes a high. So that's how downtrend looks like in a stock charts. Now let's talk about one real example, and this is US dollar Swiss franc example where the stock is going down like this. It is making lower lows and lower highs and taking resistance from this trend line. So that's how downtrend looks. And when I talk about the third direction, which is sideways, sideways means range bound market, where the market is in a range, right? So this line is resistance line and this line is support line, and the stock is there in between, making some highs, some lows within this range. So we say that this market is sideways market because it does not have any defined direction. That's why we say the market is sideways, right? Now let's talk about the real example. So real example of sideways market looks like this, where there is a channel. A channel means when the prices are within a resistance line and a support line. So that's what is happening, and this is the channel width, and within that channel prices are going up or going down. So this is what sideways trend is all about. Now let's talk about how money can be made from technical analysis. So basically there are three requirements to convert pure technical analysis into money, and these requirements are: first, to determine when a trend is beginning or ending. So first you will have to identify when a trend has begun or when a trend is ending. So this is the most important step, I think. And the second step is the money is made by jumping on the trend as early as possible. So once you identify the trend, you will have to jump on it by putting some money on it. And once you identify that the trend is up, you put your money and you go long, you buy the stock. And whenever you feel that the stock can go down, you sell your stocks or you short sell to make profit from that trend. And the third step is exit the position when the trend is reversing. So there are these three requirements which we must fulfill to make money from technical analysis. This thing looks very simple, but applying this thing is very, very difficult. So that's why we use a lot of indicators and things like that. So whenever I say you will have to jump on the trend as early as possible, I mean to say is that you will have to buy at the right time, right? So if you had bought at this level and if you had sold at this level, then you would have made a lot of profit. So that's what we do in technical analysis. We try to figure out when a stock can go up, when a stock can go down, and we make our buying and selling decision based on that. So that's what we try to do in technical analysis basically. In sum, the basic way to make money from technical analysis are: the trend is your friend, play the trend. That means always go with the trend, don't go against the trend. If the market trend is up, then you should buy. If the market trend is down, then you should sell. And if the market is sideways, then you do nothing. So always go with the trend. That's what technical analysis says. And the second rule is don't lose control risk, right? So technical analysis is a probability, it's not certainty. Let's say if you have figured out in your charts that the stock can go up, you figure out some support levels where the stock is taking support and going up, so you buy the stock based on that support level. But the stock came down after that suddenly, so you will have to control risk by selling your stock and cutting your position at a small loss, right? So that's how you lose little and you make big whenever you get right. So the second point is all about controlling risk by cutting your losses short and making your profits big. And the third point is manage your money, avoid ruin, right? It's all about money management, like what leverage should you take and how to manage your money, where to put your money in stocks or in bonds, how to do portfolio allocation, how much percentage of your money should be put on stocks, mutual funds, bonds, things like that. So it's all about money management, and we should know how to do this money management to become a good trader or a technical analyst as well. Now let's talk about why we should use TA. So TA should be used to determine the trend, when it is changing, when it has changed, when to enter a position, when to exit a position, and when the analysis is wrong and the position must be closed. It is as simple as that. So in technical analysis, we do simple things like we try to determine the trend, we try to identify whether the trend is up, down, or sideways, and we try to figure out when it is changing, and we try to figure out where to enter, where to exit a position, where to keep a stop loss, where to book our profits, where to take targets. It's as simple as that. And this definition seems very broad to me, and applying all these things are difficult, as we all know. But this is what technical analysis says, and that's why we should use technical analysis to make money in the market, to time your entries, right? Now let's talk about trend time based classification. Before we did trend direction based classification, now we are doing trend time based classification, right? So there are four kind of trends in terms of time based classification. The first number of trend is primary trend, the second trend is secondary trend, third trend is minor trend, and the fourth kind of trend is intraday trend. So trends can be of different lengths, and shorter term trends are parts of longer term trends. So I'll try to explain all these kind of trends. So let's go to the chart now and try to understand what is primary trend, secondary trend, minor trend, and intraday trend, right? So let's talk about what is primary trend first. So primary trend means where you can see the yearly data and the monthly data as well. So here I have used daily charts, right? Here I have used daily charts and I am using TradingView software. I highly recommend you to use this TradingView software if you want to improve your technical analysis skills, and if you want to learn how to read charts. I highly recommend you to use this because it is a free thing and you can do your technical analysis very well, and a lot of financial instruments are available over there. So we will use this thing quite frequently, right? So now let's talk about primary trend, right? So when I have used this daily chart, I am able to see like 8 to 10 month of data. So if I switch from daily to weekly, then you can see that I am able to look at data from 2013 to 2019. That means 7 years of data I am able to look at because of this weekly charts, and this is primary trend. So 7 year of time is a lot of time, and as you can see in this charts, there is clearly uptrend, right? So this is the primary trend of the market. So if you want to see primary trend, use daily, weekly or monthly charts, and this is primary trend. Now let's talk about secondary trend, which is the second kind of trend, right? So if I want to see the secondary trend, then I will use maybe 4 hour chart. In 4 hour chart, I am able to look at some month data. Like in this example, I am able to look at data from March to September. So this is around 6 to 7 months of data I am able to look at because of using 4 hour chart. So whenever you are using 2 hour chart, 3 hour chart, 4 hour chart, you are looking at secondary trend of the market. Now let's talk about minor trend, which is the third kind of trend. And for minor trend, I am going to use maybe 45-minute charts to look at what the trend is. So in 45 minutes, you can see the minor trend, right? And I am able to look at some days of data, like I am able to look at data from 6th of September to 25 of September. So it is a data for few days. And if I zoom it out a little bit, then I am able to look at few weeks data or few month data. So you can use this 45-minute chart or 1 hour chart to look at the minor trend, right? Which ranges from few weeks to few months. And if I talk about intraday trend, then intraday trend, you use 15-minute charts to look at what the intraday trend is. So if I use 5 minutes as well, then also I am able to look at this minor trend, which ranges from few days to few weeks, right? So this is what minor trend is, right? So these are the four kind of trends which we have. Trends are of different length, and the shorter term trends are part of longer term trends. Now what do I mean by that? Short term trends are part of long term trends. Now let's understand this thing on our charts. And if we go to the charts, then you can see that every day the market opens and some kind of data happens, like prices always goes up and down, and these kind of data adds up to the long term charts. Like these 5 minute data which is happening will be added up to 1 hour chart, and that 1 hour data which is changing will be added up to 1 day chart, right? So shorter term trends are part of longer term trends. What do I mean by that is that whenever short term trend is happening, then it will add to the long term trend as well, it will contribute to it. So that's why we say short term trends are part of long term trends, right? Now the question is how the trends are identified. We have talked about trend importance and so on. Now the question is how do we identify this trend? So there are various methods to identify trends, but these three methods are most popular. And the first method is linear least square regression, which is a statistical method, and where we use statistics to identify the trend. This method is not used by technical analysts or chartists, so we are not going to discuss about that. If you want to read more about this, you can go to internet and read all that stuff that is there on linear least squares regression. And the second kind of method to identify trend is moving averages, which is very important and very old method to identify trend, and which I use very oftenly. So now let's understand how to use moving averages to identify trends, right? So now let's go to the chart. And now we have opened the chart of HDFC. So if I use this moving average, then I am using right now a 50 days moving average, which is clearly depicting the direction of the market. As you can look at this chart, you can clearly see that this yellow line is going up. That means the trend is up, right? So whenever this yellow line goes sideways, whenever this yellow line starts to get flattened, we can see that the trend is sideways. And if we go back a little bit, then we can see that this yellow line is going up like anything. So at this time the market is trending, so moving averages are helping us to identify trend, right? So this is one of the most important tools to identify trends, and this was the second method on our list. And the third method is trend lines. Now let's talk about trend lines. Let me hide this moving average. If I draw this line, then you can see that the trend is down over there. And I have just drawn it to show you how to draw a trend line. And maybe you know how to draw a trend line. This is very basics, but I'm just telling you what are the methods to identify trends. So we can use trend lines to identify trends. So these are the three methods which we use to identify trends, and moving averages and trend lines are the most common methods to identify trends. Now let's talk about why do market trends. So market trends because demand and supply don't react immediately, they trend. Therefore, prices trend. Sometimes demand will be high, sometimes supply will be high, sometimes demand will be low, sometimes supply will be low. So all the demand and supply factors will keep on changing. So that's why prices trend. Whenever the demand is high, prices goes up because everybody wants that commodity or that stock. So that's why prices goes up, and the vice versa is also true. And the reasons for finding demand and supply is infinite. There are a lot of factors which are out of your control, which you cannot read and which can affect demand and supply in a stock. The reasons are infinite. You cannot pinpoint all the reasons why the stock is going up or going down. So therefore we use price because prices says everything. And whatever the news is there in the market or whatever company fundamental is all about, these all things are reflected in price. That's why we read price to figure out what the trend is. So now let's talk about assumptions of technical analysis. This is one of the most important concepts of CMT exam. So just start this point, and I think you should know what are the assumptions of technical analysis. Once I was giving an interview and the interviewer asked me this question, tell me what are the assumptions of technical analysis, and I was not able to answer that question because this thing was very basic, and I thought who would read that basic thing. So I didn't care about learning this assumption of technical analysis. And this was something which was important in CNT exam as well, and in interview as well. People ask you such questions. If you are giving interview in research field, then people will ask you such questions. So this thing is important. And if I talk about assumptions of technical analysis, then there are 6 assumptions of technical analysis. Right now let's go through every assumption one by one. The first assumption is price is determined by interaction of demand and supply. What do I mean by that? Let's understand this on the charts. So whenever a stock price is going up, that means there is demand for the stock. There are more buyers and less sellers. That's why prices are going up. And whenever our stock is going down, that means more sellers are selling and there are less buyers. That's why prices are going down, right? If the buyers are equal and sellers are equal, then the prices would stabilize, right? So uh, prices are determined by demand and supply. Sometimes demand change, sometimes supply changes, sometimes supplies goes up, goes down, and this thing happens constantly. And that is why price change happens. So I think this point is clear. Now the second point is price discounts everything. So by discounting everything, I mean to say that all the information, all the publicly available news which are there in the market is already discounted in price, is already reflected in price. Let's say a company is having bad fundamentals, or the news about that company is bad, so the prices would go down automatically if the news is public, right? So prices are discounting everything, we know that, and that's why we say price discounts everything. I think this point is clear. The third assumption is prices are non-random in nature. So whenever trading happens in the market and they buy or sell out of fear or greed or maybe hope, so there are emotions in the market. People buy because of certain emotions, people sell because of certain emotions. So whenever prices are changing, whenever it is going up or down, it carries a lot of emotions. And because people are selling these stocks, people are buying these stocks, so there is certainly emotion in the market, and which is reflected in price. That's why we say prices are non-random in nature. Prices are not going up or down because of some randomness. It is going up or down because of human psychology, because of fear, because of greed. So this is what third assumption of technical analysis says. And the fourth assumption is history will repeat itself. Now what do I mean by that? History will repeat itself. Let me show you in the charts. So if we go to the charts, and if we try to figure out where the support level is, where the resistance level is, so let me draw some support and resistance level to tell you what do I mean by that. So here I have drawn up a line which is a support line, and as you can see that the stock is taking support from that line. and again taking support, going up, again taking support, going up. So as you can see in this chart that the stock is taking support, then again taking support and going up. So this is history, right? This is history. But if in the future, if the price comes down to this level, and if the price start taking support at this level and goes up, then we will say that look at this chart, history is repeating itself. Before also the stock took support from this level, and today also the stock is taking support from this level. We will say this because this level was tested historically as well. That's why we say this. That's why we say that in the future also this level can be tested, right? So that's why we say history will repeat itself. There are a lot of examples where you will find that history repeat itself. I'm just telling you a very simple example so that you can understand the concept, right? Now the fifth point is prices are determined by people, therefore they form into patterns and have predictive ability. As we all know that prices are determined by people because people trade, people have emotions like fear, greed, hope. So whenever people act because of these emotions, then these kind of patterns form, and these kind of patterns have predictive ability. In my previous example, I told you about that support level. When I drew that line, then after that the stock was taking support from that level a lot of time, right? You can look at this chart. I drew this line, and after drawing this line the stock was taking support from this level a lot of time. So we can predict that maybe in the future the stock can take support from that level. So we can kind of predict what will happen in the future, and that's why we say prices have predictive ability, right? Now the sixth assumption is patterns are fractal. Now patterns are fractal. What do I mean by that? Let's understand this. Now before understanding patterns are fractal, let's understand what does this fractal means. So Ben Wise has given a very good definition of fractal, and Ben Wise is an American entrepreneur who said that whenever you are observing a series of patterns repeating over and over again at many different scales, and where any small part resembles the whole, that is a fractal. Now to understand this definition, we need to divide that definition into small points so that you can understand things in a better way. So whenever you observe a series of patterns, whenever you observe any pattern like support, resistance, flag and panic pattern, any candlestick pattern like doji, and whenever you observe such patterns repeating over and over again, like if doji candle happens at 5-minute charts, then it can form in 1 hour chart as well, it can form in 1 day as well. That's why they are saying that at many different scale, at 1 day as well you may see that doji candle, in 5-minute charts as well you may see that doji candle. So that same pattern is repeating over and over again in many different scales, and where any small part resembles the whole. In 1 day chart also the doji candle may look very similar to 5-minute chart. So that's why we say these patterns are fractal, right? So a doji which is formed in 5-minute charts can be found in 1 day chart as well, and a lot of other patterns like flag and pennant pattern, ascending triangle, descending triangle, support, resistance, these all kind of patterns can be found on different time frames, right? So thank you for watching this video. If you have any questions, you can ask me in the comment section. And if you want to connect with me, you can find me at Instagram. You can mail me as well. And you can subscribe to our Stock Brain channels to watch more videos of CMT exam, right? So if you want to watch more videos on CMT, then I am making a playlist where I'll make every video chapter wise. So whenever I'll upload a video, you will find it over there. So if you want to watch that video, and if you don't want to miss out these CMT videos, then I would recommend you to subscribe to our channel so that you don't miss out any of the videos which I am going to make in the future. So thank you for watching this video. I'll see you next time with another CMT topic video. Thank you for watching.